inversion fair value gap seems to be the new buzzword for paid group leaders and marketers, but most of them are overhyping the concept or totally confusing it by adding random complications to it. So in this video, we will be covering what are inversion fair value gaps, high probability way of using inversion fair value gaps, is it worth using inversion fair value gap, alternate ways of execution, for example liquidity sweep, order blocks, fair value gaps and SR flips on lower time frame. So let's get started. So let's get straight to a topic of inverse fair value gaps. But before studying inverse fair value gaps, you must have a knowledge of fair value gaps. So fair value gaps are of two types. One is called a BISI and the second one is called a SIBI. BISI is a bullish fair value gap and SIBI is a bearish fair value gap. So let's see more about these gaps. Now if we come on to the BISI, now BISI is a bullish fair value gap and it is created when we mark the high of the first candle and the low of the third candle. The inefficiency present here is known as BISI or bullish fair value gap. And what is the function of this fair value gap? It will act as a support for price to move forward. Let's see an example of this. Here you can see we are in an uptrend on the higher time frame and we mark the high of the first candle and the low of the third candle. The gap between them, which is marked with the orange block, is known as what? Is known as BISI or bullish fair value gap. And this will act as a support for price moving forward. Okay, it is clear. In a normal circumstances, BISI or bullish fair value gap will act as support for price. Now let's move on to SIBI. SIBI is a bearish 3 candle pattern and it is formed by marking the low of the first candle and the high of the third candle. This fair value gap will act as a resistance for price. Price will come in this fair value gap and will reject off of this. This is a bearish fair value gap. This is a bearish fair value gap. So let's see an example of it. Here you can see we are in a downtrend on the higher time frame and we mark the low of the first candle and the high of the third candle. The inefficiency or the gap between them, which is marked with the orange box, is known as SIBI and this will act as resistance for price. I hope the concept of SIBI and BISI are clear up till now. SIBI will act as resistance and BISI will act as support. Now this is only applicable in normal circumstances. When you consider inversion fair value gaps, things change a little. So let's move on to inverted fair value gap. Up till now, we have studied that BISI acts as a bullish fair value gap or as support for price and SIBI acts as a bearish fair value gap or resistance for price. But when we considered inverted fair value gaps, the roles of SIBI and BISI interchange. BISI becomes bearish and a resistance for price. And what would SIBI become? SIBI would become a bullish fair value gap and would become as a support for price. So I hope it is clear. It is a really simple concept that in inverse fair value gaps, the roles switch. Bullish fair value gaps become bearish fair value gaps and bearish fair value gaps become bullish fair value gaps. It is this simple. Nothing complicated. Now let's move on to some examples of this. Now in this example, consider these 3 candles 1, 2 and 3. If you mark the high of the first candle and the low of the third candle, the gap between them or the inefficiency is a BISI or you can say bullish FVG. And what is the function of bullish FVG? To support price. In normal circumstances, this would support price. But as you can see, price didn't hold this fair value gap and broke through it, which means that this BISI was disrespected and now this can be considered as resistance. And this BISI would now act as resistance. Why? Because this fair value gap BISI initially didn't supported price and price broke through it. So now when price comes back again to it, it will act as resistance. Why? Because price didn't behave normally. Because in normal circumstances, price would have gotten a support from here and would have bounced higher towards the higher side. But it didn't happen. It broke through the fair value gap, which means this BISI will act as resistance, not as support. And hence, this gray area would be considered as inverted fair value gap. So I hope this concept was clear. Now let's move on to bearish fair value gaps. Now here you can see, if you consider these three candles 1, 2 and 3. So the low of the first candle and the high of the third candle would act as inefficiency and would create this gray box known as what? SIBI. This SIBI should have acted as resistance in normal circumstances. But this isn't a normal circumstances scenario. Why? Because you can see price disrespected this SIBI and closed above it. This means when price will come back again to this area, as you can see here, we must look for longs instead of shorting this, because now the SIBI has turned into an inverted fair value gap and hence its function is reversed. Now it will support price. Why? Because it initially didn't respected price. You can see if this was a SIBI in normal circumstances, price should have gone down, but it didn't respected this SIBI and broke through it and closed above this SIBI. This means that now the SIBI would act as a support and hence we must look for longs if price comes in this gray area targeting these highs. So the concept of inverse fair value gap is this basic and this concise. You don't need to overcomplicate it. You just need to practice it again and again to get an eye of it. So basically, whenever, if I could write it here, whenever SIBI starts supporting price, starts as a support for price, it is an inverted fair value gap. However, when BISI starts to resist price, it is a inverse fair value gap. You can also see this table which I have created above. This is a good reminder. Yes, here. In normal circumstances, BISI acts as a bullish fair value gap and SIBI acts as a bearish fair value gap. However, in inverted circumstances, BISI acts as a bearish fair value gap and SIBI acts as a bullish fair value gap. Simple. I hope nothing is confusing up till now. Now let's move on to our next topic. Our next topic is to study the high probability way of trading inverse fair value gaps. So first step in that is establish the higher time frame trend and make sure that your trade is with the trend. Second step is to take a trade after a red folder news has happened, and the third step is to take a trade after the liquidity sweep has happened. So let's look at an example of a high probability trade using inverse fair value gap. So here you can see this is a Euro USD chart on the higher time frame. What does this indicate? That the price is moving bullishly. The trend is higher. So our first condition is met, that we have found the trend that is higher or bullish. Now let's move on to our second and third steps, that were to take a trade after a red folder news and after a liquidity sweep has happened. Now here you can see this gray candle was the red folder news and it took out the liquidity of the Monday low. Also it closed back inside the Monday low. So this is a potential long. But we didn't see how we executed with the inverse fair value gap. So let's move on to the lower time frame, and here you can see this is a 5-minute chart on the Euro time frame, and as you can see the red folder news took out the Monday low and closed back inside. So it was a liquidity sweep. Our second step was satisfied and it was a red folder news. So our third step was also satisfied. Initially, if you see this fair value gap, which is the first candle low and the third candle high, this was a SIBI. And normally we know SIBI acts as a bearish fair value gap. But if you see price, it didn't respected this SIBI and closed back above it here. So this would start to act as a support for price and would be a inverse fair value gap. So now when price hits it, we must look for longs here. Here you should long with a stop loss below the lows here and targeting these highs. So this would be a 1 to 2 hour trade. I hope the concept was clear. Now let's look at another example in which we are using inverse fair value gaps in a high probability way. Okay, so this is a US oil chart. This is a US oil chart, and as you can see, the higher time frame trend is bearish. You can see we are moving down. So it would make sense to take shorts here. So our first condition is satisfied. That is, we know the higher time frame trend. Now let's move on to our second and third condition. Here you can see on the lower time frame, we took out the liquidity on a red folder news. This candle was a red folder news and the liquidity was swept. So our second condition was also satisfied and the third condition was also satisfied. So now let's look to execute using inverse fair value gaps. Here you can see if we mark the first candle high and the third candle low, this fair value gap would have acted as a BISI. And normally in normal circumstances, you know, BISI acts as a bullish fair value gap. But if you see price here, it didn't respected this fair value gap and broke through it. So now this BISI will act as a resistance. So now when price comes and tests this fair value gap, we will look to short. And we did short here and place the stop loss on the highs for a 2 to 3 hour trade. So I hope this example was also clear. We looked at a bullish example and a bearish example. So now let's move on to the main topic as to whether inverse fair value gaps are really that important. Firstly, let me clear that inverse fair value gaps do work and some of the traders have utilized this as a good execution tool. But some paid group leaders and fake gurus are acting like this is the best thing in trading. But it is not. It is as useful as some other executional technique, and sometimes it is worse than that. There are better execution techniques than inverse fair value gaps, and you can use them to get a high RR than inverse fair value gaps. So please don't trust such scammers who sell you a $250 course just for inverse fair value gaps and have no track record to prove that up. So please stay away from these guys. You know who this guy is. So please stay away from him. He claims to have a 80% track record or win rate with inverse fair value gap, but shows no result. No results are shown over a sustained period of time, over a 1 year time or even a 6 month time, and claims to have a 80% win rate with inverse fair value gap, which is absurd. And he is launching a course for it as well. Please don't subscribe to such evil paid group advice. This will only work out to be bad. So please stay away from them. So now let's move on to the other execution techniques that are sometimes better or even close to inverse fair value gaps. So there are 4 alternate methods to inverse fair value gaps for executions, and they sometimes give better results than inverse fair value gaps. So first of all, we have the liquidity sweep. Second of all, we have the order blocks. Thirdly, we have fair value gaps. Fourthly, we have the SR flip on 1 to 5 minutes. Now the first approach, that is of liquidity sweep, is an aggressive approach and requires order flow data as well. So I wouldn't be covering it here. Now we will look at the other 3 techniques. So if we come on to the previous examples only, previously here you saw we took a long with the help of the inverse fair value gap for a 2-hour trade. You can see here 2-hour trade was taken and we have the higher time frame narrative as bullish. The liquidity was taken on the red folder news and we utilized the inverse fair value gap for a bullish long. Now let's see how would I take a trade if I utilize this breaker. You can see this breaker and market structure shift could also be utilized to take a trade, and you would have netted a greater R, a 3-hour trade. And in the inverse fair value gap example, how much you netted? 2 hour. So sometimes there are better execution techniques than inverse fair value gaps, and they are much simpler. So people just like to complicate things. Instead, trading is really simple, and the more simple you keep it, the greater would be your results. So let's look at the bearish example again as well. So here you can see this is a bearish trend. We took the trade when the second and third conditions were filled of the red folder news and the liquidity sweep. And if we applied the inverse fair value gap concept, we got a 2-hour trade. If you can see here, approximately 2-hour trade. But if we applied some other execution techniques such as SR flip region or structural break, if you can see the structure was broken on the lower time frame, and the SR, you could say this as the SR as well, the structural break as well, the structural shift as well. If you applied that execution technique and executed somewhere here, you would have netted a trade of 3 to 4 hours. So sometimes, or most of the times I would say, and I have seen this, keeping things simple makes your trading the best, and inverse fair value gap unnecessarily adds complications. You can be good with the breakers, order blocks and fair value gaps, and that will do the job for you. If you want to learn more about ICT's concepts in a simplified way and to keep trading simple, you can watch the playlist on the right hand side.